Good morning, ladies and gentlemen. Welcome to the 2021 Budget Review and Legislative Update webinar. For those of you who've never met me before, my name is David Beattie. I've been at HR Talk for 21 years, and my position is the Legislative and Compliance Manager. So this is certainly my field of expertise. We've been doing these presentations for over 20 years, and obviously because of COVID and because of technology, this doesn't have to be done face-to-face anymore. But welcome. Just a little bit more about me. I'm an ex-SARS employee. I spent 6 years at SARS in the early to mid-90s. I've then been with HR Talk since. My area of expertise is employees tax, Uif workmen's compensation, but I do keep abreast of income tax changes. I deal with quite a lot of tax returns, those types of queries. I do a lot of training. I do salary structuring, and obviously dealing with SARS and the challenges that they bring. But the points of focus today is the 2021 budget that happened at the end of February. And then we're going to look at a couple of legislative compliance issues that raised their head since the last budget. Some of them are proposals, so we're going to be waiting on changes, and we should get more information a bit later in the year. But let's press on. Sorry, but before I continue, I will take questions at the end, and you are welcome to email me or phone me if you want to ask a private question if you're too shy. So we'll do that at the end. But let's go. So our finance minister in the budgets, he didn't really shock us too much. We were expecting quite a lot of drama. We were expecting significant changes because of the situation that our country's in. And personally, I was expecting either another VAT increase or an increase in the tax upper end of the tax tables. It didn't happen. And my concern at the time, I think, walking away from the budget speech was, where was the money going to come from? We're all aware of the impact that COVID has had on our country and on the world, and we all know that our economy effectively shut down for a certain period of time, and a lot of industries have battled to get back on their feet and get back to normal productive capacity again. Obviously, the biggest loser has been the employees. We've seen ridiculous unemployment figures, and the unemployment situation in South Africa was very much a deep-rooted factor in this budget speech. The unemployment rates in the fourth quarter of last year increased by 1.7% to 32.5%. Look, I know that's a stat, but I think we would be remiss to not consider the informal economy here. That is formal economy. The informal economy is those people that are selling on the side of the road, their employees, their runners, those type of people. So I would expect the unemployment rate to be significantly higher than that. But, as this report that I quote says, this is the highest since the start of the survey in 2008. I mentioned that taxpayers can breathe a sigh of relief. As I said, we were expecting tax hikes. We didn't get tax hikes. We got relief for middle to lower level employees. Government says that relief is above inflation. But then again, obviously, what is inflation? Is is the man in the street really better off from this budget and the change in tax tables? I will leave that up to you to decide. As I mentioned, COVID had a huge role to play in the budget. The majority of South Africans are sitting waiting for their vaccinations for COVID. Where was the money going to come from to import all those vaccines? Never mind the fact that the first batch that we got was a vaccine that wasn't working, or didn't work sufficiently. So poor Mr. Mboweni had to factor in more money for this vaccination program. And we're probably going to see that cost snowball as corruption eats into the COVID vaccination process and the acquisition of vaccines. I'm expecting to see some sort of notification from government pretty soon as to how they're going to roll out to start vaccinating us, normal people. Last bullet point, the consolidated spending is expected to amount to 6.1 trillion over the next 3 years, or 2 trillion a year, with the majority of the spending going towards social services. Now, it's never a good idea when social services is the focus of a budget, because that is money going into a deep pit. But when you look at the tumultuous history of South Africa and the inequalities in our society, it's not unexpected that so many people in our country would be utilizing government grants, etc., to survive. Those people were certainly put under pressure during the COVID period. Let's briefly chat about COVID-19 and vaccination funding. Government has set aside 19.3 billion to fund vaccines in the interest of saving lives and supporting the recovery. I think that's all very noble. 10 billion will be used to purchase the vaccine over the next 2 years. I think we all hope that 10 billion is going to be money well spent and that we're getting good deals directly from the manufacturers and not making middlemen rich. But I'm still concerned that government has not partnered more obviously with the medical aids and allowed medical aids to get involved in this process earlier and quicker. We all know that the third wave is on the horizon as winter starts to approach, and it would have been ideal to have more people vaccinated before then, but it's quite clearly not going to happen. Obviously, government's intention is to inoculate 66% of the population, and they believe that that would control COVID. No new taxes have been introduced to fund vaccines. That was a proposal. We were expecting some sort of a once-off tax to help fund this, but government has taken the money out of the budget. And there is a contingency reserve, which obviously gets plundered periodically. Vaccines will be rolled out free of charge to the majority of South Africans, while private providers will be able to claim back from medical aid. We need that happening sooner. We need the medical aids actually driving this process to get their members vaccinated. Direct taxes. As I mentioned earlier, we didn't see any tax hikes, and we actually saw a proposal that's going to reduce the corporate tax rates, but we'll discuss that a little bit later. Government's putting a lot of emphasis on easing financial pressure on households and to get business back to its optimum level, to increase employment and obviously output. When I talk about the state had a revenue windfall in the latter part of 2020, this was a windfall that government weren't expecting. Government were expecting very, very poor figures, but there was a sudden influx of corporate tax payments, particularly from the mining companies, and in terms of the mining, this came off the back of improved commodity prices, but our country got back onto its feet a little bit quicker than people expected, and people started getting paid again, and obviously consumption increased. So the economy is a little bit brighter than I think the average person expected. The tax revenue shortfall is now expected to stand at 213 billion. That is jaw-dropping. It's lower than 312 billion projected, okay, but it is still a massive shortfall. And anyone with any common sense would know 230, you're not collecting 213 billion, that money has to come from somewhere. There was also a proposal last year to raise 40 billion in additional revenue. That proposal was withdrawn. Hikes on the indirect taxes. We've seen the increase in the excise on alcohol, tobacco. That's pretty much an easy target. Government tell all their nice flowery stories in terms of it's going to improve your health, it's better, there's less strain on government resources, hospitals, due to alcohol consumption. But at the end of the day, easy targets. Most people drink, most people enjoy some sort of pleasure from one of the sin taxes. So it's, as I said, an easy target, increase that by 8%. Going back to unemployment, governments said despite government efforts to boost creation, soften the blow, the unemployment shows no signs of letting up. And the reason that is because government thinks that throwing money at projects and creating short-term employment is the solution. That's not the solution. The solution is to get people into small and medium businesses. You need to create an environment where employers have less red tape and it is easier to do business. Taxes are lower and they can spend more money employing people to expand businesses. Unfortunately, it's quite hard to do, and the government do not want to do that because of the fact that it is too hard. So it's easier to throw money at infrastructure projects. And I'm not saying that that's necessarily bad. It's just that a lot of those projects are not long-term. So you're creating short-term employment. 12.6 billion, in fact, was allocated to the various sectors to create 694,000 short-term jobs in that financial year, and that is expected to increase. Now, I go back to the informal economy. If the country is doing well and people are in employment, those people in the informal economy will be doing better. They will be able to employ. Obviously, with COVID, you've seen people shed those types of jobs, and that's where the biggest need is. Those are the people that are looking after extended households. So that is where effort has to be placed. Unfortunately, it's a double-edged sword because your average person in that informal economy does not want to come into the tax net and pay tax. And then we have, as I said, the double-edged sword of we want them in, they don't want to be in. How do we get the tax? And unfortunately, the only approach is to increase the VAT rates because that is a consumption-based tax, but that draws the ire of the unions, and the government does not have an appetite for that fight. So there's mention of by January of this year, there was an initiative to create 430 temporary jobs and another 180,000 by March. Quite keen to see how that pans out when the stats come out. Wages. Governments are on very, very thin ice when it comes to public service wages. You know, every time there's a strike, they enter into agreements, often multiple-year agreements with public servants, and most of the time they're offering above inflation increases. Now, our country can't afford above inflation increases, and we certainly can't afford coast employees and bloated public service. So there has been an effort by government over the last couple of years to reduce headcounts, put people on early retirement, not full positions, and obviously put a freeze on non-essential posts. Unfortunately, you know, in my experience, when I worked at SARS, when they had this type of initiative, the only people who really actually left under such programs was the people who could find other employment. Your dead would stay, and unfortunately, you're going to have that in government with those people that staying adding very little to the bottom line in their departments. Quite frustrating. The unions have already said that they're going to challenge any attempt by government to renege on previous agreements. So we've got that in the courts at the moment. Obviously, the union's looking at their workers being at the lower end of the spectrum. Those people, as I also mentioned earlier, are looking after multiple households, so they need every cent they can get. It's just, is it fair on the taxpayer for someone to get an increase of 3 to 4% above the inflation rate every time? Probably not. So watch the space in terms of cutting costs in this area. We all know that in terms of spending, the majority of spending goes into economic development, the social community development, general public services, and health. Those are all areas that are drained on the fiscus, and obviously COVID hasn't assisted. So very little money is actually going into projects that are beneficial to the long-term state of our fiscus. This slide, I refer to the debt pit records. We've been looking at this debt pit for many years now. Most of the budgets have just papered over the cracks. I don't think we've gone anywhere towards really making massive changes in our country. And the rating agencies have not been blind to this. And obviously, we've seen significant changes in our rating, which makes it more difficult and more expensive to get money. And it also makes South Africa less attractive as a destination for development of businesses, as an example. So the debt service costs, okay, they're higher than the 2020 budget. We've seen massive increases. If you look at the debt servicing costs, they increase at an average rate of 13.3%. Now, just bearing in mind inflation is 3.3%, approximately 3.3% at the moment. Our debt is increasing at 13.3% per year. And as I've said there, we're reaching 338 billion in 2023, 2024. It looks like we're actually just shuffling the chairs on the deck of the Titanic at the moment. We keep on saying that this is increasing, but we're not doing anything about it now. There seems to be a lack of appetite to actually get control of things right now. So we've got a higher budget deficit. We've got fluctuations in interest. We've got an inflation rate that's not too bad at the moment. We've got a very fluctuating exchange rate. We've got massive debt costs. We're in trouble. Obviously, with any budgets, the only way you can reduce that acquisition of debt is to reduce either reduce your expenditure or increase production. We seem to be failing in both. Our state-owned enterprises in the newspaper every single day. The state-owned enterprises, just think of Eskom, think of Denel, think of SAA. They are a money pit. All of those organizations are very far from standing on their own 2 feet, and we've seen bailouts for most of them. I see that recently Denel was refused the bailout, but the biggest money pits, Eskom and SAA, are getting bailouts. Many of these state-owned enterprises are risk defaults, or they on the verge of defaulting. And a lot of the times Treasury, obviously to save money, has to bail them out, as they don't want to incur the penalties for defaulting on payments. But I'll refer to the Land Bank defaulting on its debt. The Land Bank obviously is one that government puts a lot of money into as part of the turnaround strategy, to put land in the hands of previously disadvantaged people. So they can't default on that. Defaults on bank loans has a huge impact on the cost of financing and would send a really bad signal to foreign funders. And the medium-term budget refers to the fact that 7 billion would be required to restructure this entity in the medium term. Very, very scary. What does that mean? Is that money getting thrown down the toilet? Is it to pay off people that are not competent? Is it to fund programs where bad loans have been made? Goodness knows. I'm not an expert in that area, but if it's like any of the other state-owned enterprises, I can only imagine. The state has budgeted 791.2 billion for infrastructure investment. This is obviously one of the main areas of job creation. But like anything in the budget, like I said earlier, there's no clear timetable. So is this just smoke and mirrors to make us feel better? Or is it an actual program? I actually, at this point, don't think they know. The economy, it's expected to rebound by 3.3% this year. I think that is very, very ambitious. Can't see that happening. And we also mentioned a 7.2% contraction in 2020. Obviously, that was much to do with COVID. But the minister, I suppose he's paid to say this, said there's a reason for hope for South Africa's much improved economic outlook. The global economy will be buoyed by the expected rollout of COVID-19 vaccines. Terrible when any economy requires money to be spent on vaccines to be successful. Okay, so just some figures you can have a look at. The main budget revenue is projected to be 1.35 trillion, or 25% of gross domestic product. The budget expenditures, however, is going to be 2 trillion. So very, very basic maths. You are 65. So yeah. Sorry, where did I get to? You are short by a significant amount of money right there. Real GDP is expected to grow 3%, 3.3%, and 2.2% in 2022. Not quite sure what that is. Gross debt has increased from 65 to 80% of GDP. That is something to cry about. Debt almost is equal to what our annual GDP is. And with debt comes interest, which we'll discuss shortly. The proposed fiscal framework will stabilize at 88.9% in 2025. So that's almost debt equal to GDP in 3 years' time. In the medium term, debt service costs are expected to be 21% of the tax revenue we collect. So 21 cents out of every rand that SARS collects goes to servicing debt. That is way out of kilter. That money should be spent on infrastructure and the provision of services to taxpayers. This is the largest tax shortfall on record, collecting 213 billion less than was expected. Funds in excess of 10 billion have been set aside, which we've said in terms of COVID, and we've had no wealth taxes. Now, going back to personal income tax, a figure of 5% was mentioned in terms of relief at your lower end, middle end of the tax tables. Those of you who've done your sums or have looked at your March payslip will cry into your drink because the change is so insignificant. It's not fair. On a personal perspective, I just see my insurance policies going up 10% per annum. I see rates and taxes going up 15 to 20% per annum. I see the fuel cost going through the roof. You can see food costs from month to month, how they change. This 5% adjustment in the tax tables is just a drop in the ocean. Every year, the Treasury changes the medical aid tax credits. I think the exception was last year, but we've seen an increase in the credit for the first two people from 319 to 332, and for every other beneficiary from 215 to 224 Rand per month. I think this is all short-term benefits because, as we know, the Fiscus has medical aids in its crosshairs, and it was interesting to note that not much was said about national health this year. So I think the adjustment to the medical aid credits is just a rollover with the expected changes still to come. The corporate income tax change with much fanfare. It was mentioned that the corporate tax rate was going to go from 28 to 27%, but that is only for tax years from 1 April 2022. So that's in the future. We're going to have to live with 28% for the next tax year. The reduction in taxes arising from the lower tax will be funded through the limitation of interest deductions and assessed losses. I don't want to give an income tax lesson, but government has been focusing on interest deductions and assessed losses as a means of potentially raising taxes for some time. A lot of companies have bought massive assessed losses and do not pay tax as that assessed loss gets eaten away every year. Obviously, that is a loss to the fiscus. And then a lot of companies are also developing structures where interest costs are significant, and then interest costs eats into inflation, into profit, and results in less tax. So governments are looking at limiting interest deductions and assessed losses as a means to get rid of them and make sure that more tax actually gets paid into the fiscus. Venture capital company initiatives. This was just an incentive that was initiated in 2019. It was just a system to give a step up to companies trading in certain areas with tax concessions. Government has had a good look at that, and those concessions have not borne any fruit. And the type of industries that they'd hoped to pull into the net didn't materialize, and your normal industries took advantage of this. So governments have said that as of 30th of June, these would fall away. Fuel levies, another soft target. The money from the fuel levy will increase by 15 cents a litre for the road accident fund. So the general levy and 11 cents for the road accident fund as of 7th of April. We've had recently very high oil prices, so expect to see petrol and diesel increases above 1 Rand a litre as of 7th of April. Slight decrease in the oil price in the last couple of days, but we'll probably only see the benefits of that in May. Special incentives, and those incentives are specifically dealing with airports, the ports, rail, stock, and loans for building and residential units. The sunset dates, in other words, those will end on the 28th of February 2022. A lot of these incentives were introduced with much fanfare and haven't panned out as expected. So, they're going to stop them before they cost the fiscus more money. Learnership tax incentives, another area of abuse. Government's looking at this at the moment. The learnership incentives will continue, but expect to see changes in the next budget, potentially, or the budget after that, to withdraw the incentive. That will happen if the type of abuse that is happening with the ETR system is entrenched in the learnership tax incentive system. And then I mentioned before, 8% increase in alcohol and tobacco levies. Plastic bags, reduced levy for bio-based plastic. Ordinary plastic bags will continue to be taxed at 25 cents. The Uif contribution ceiling, there's, for the first time in 4 years, there's a mention of an increase. They mentioned that the contribution ceiling would change from 14,872 to 17,711 rand and 58 cents. That's since been changed to 17,712 rand. The effective date is 1 March. That has since been postponed. Well, it's postponed until it can pass through the legislation process, but we're expecting that to be backdated. So watch this space. We will communicate those changes as and when they happen. Strengthening SARS. Just a little bit about SARS. SARS did do pretty well last year, and Treasury are buoyed by the fact that they collected so much money. They are going to be allocated 3 billion rand, and that's going to be to expand data analytics, artificial intelligence capabilities, and increase the skills. Those people who work with SARS on a regular basis will know that the large business centre was decimated under Commissioner Tom Moyani. That section is recruiting and is back on its feet, and a lot of the staff in that section are going to be utilised in audits on the large corporates that have got global reach, and also on doing lifestyle audits on the wealthy in South Africa. But SARS is spending a lot of money on software to improve their analytical ability, and it's already bearing fruit in terms of third-party data that SARS has access to. So in future, you can expect to have information on your tax return that is not just RP5 certificates, medical aid, RA certificates. SARS are going to be playing smart, and they're going to be sourcing information from all over. So those people with rental income that they don't declare, who are working through maybe an estate agent, maybe expect to see the SARS tentacles reach out to those types of organizations. You've got money overseas. If you're not declaring it by now, expect to be hammered. Almost every overseas tax authority has signed agreements with SARS to provide information. So it's just a matter of time until your worldwide empire is exposed. So rather play safe and declare to SARS. So this 3 billion, a lot of that will be spent next year, but I am aware that they're recruiting quite aggressively, and you're going to start seeing more compliance audits. A lot of those will be online audits, so you won't necessarily see warm bodies, but you're going to start getting requests for information that will make your life quite comfortable. Further important budget proposals. Treasury is going to look at the current travel allowances and home office allowances. Very much like the venture capital and the learnership schemes. They're quite keen to see how effective these allowances are. Are they achieving what they desired? Is there abuse? Is there fraud? And I think we can all agree that travel allowance is a wildly abused system, and we foresee that changing in the foreseeable future to a reimbursive travel scheme, which will obviously place the onus on the employer to be more careful as to how they refund an employee for business travel. A lot of our clients have seen reviews already of SARS looking at reimbursed payments and then looking at the employee's tax returns. And if you're stupid enough to have that difference, you would have a reassessment. So it's imperative that you apply your logbook with honesty, and it actually ties up to services and your actual employment travel. Just a word of warning: if you are going to be putting together a logbook, make sure that there's no business travel during a hard lockdown, and even after that, the various lockdowns where travel was limited. If your logbook doesn't match those dates, your travel claim is going to get thrown out as being fraudulent. Home Office, the rules are very, very strict, and there has been some chats, particularly over the lockdown period, as to whether SARS would ease the restrictions, bearing in mind that employees are now required to work at home. The Payroll Authors Group took that up on behalf of companies and the employees, and SARS came back and said no, there'd be no easing. The legislation would be applied as it is, and unfortunately that's going to exclude the majority of people working from home. Very briefly, unless you have an office that is equipped, that is used only for business purposes at home, it's got a desk, it's got internet, it's got a phone, it's got books or ledgers or whatever that is applicable to your job, you will not be entitled to a claim. So common room, maybe where your wife does arts and crafts and where your kids play computer games, anything like that would be disallowable. And we've spoken about the assessed losses. We await further information from Treasury. I'll put up the tax tables for you. Not much to see there. Obviously, the primary rebate at the bottom has changed to 15,714. But if you do the maths, you'll see the top three, maybe four brackets are the ones where we've seen the most improvements in take-home pay. Secondary, tertiary rebates have also changed in line slightly above inflation. Quite a big change in the tax threshold at which you start to pay tax. So, you know, a lot of the people at the lower end of the scale now are still not going to be paying tax, as opposed to maybe paying a couple of thousand tax a year under the last threshold. And then we've seen obviously also changes in the threshold in which over 65s and over 75s pay tax. No change in the local interest exemptions. These exemption rates have stayed that way, I would say, almost for 10 years. As I mentioned earlier, the medical aid tax credits have gone up to your first two people, 332 Rand each, and every other dependent, 224 Rand. No changes to the calculations for determining whether an employee qualifies for a secondary medical tax rebate. Pension fund contributions, the rules stay exactly the same, the 27.5% of remuneration or taxable income, with a limit of 350,000 a year. I was thinking that this might go up slightly to encourage further contributions to retirement funds, but the government didn't have an appetite for that this year. Travel allowances, no change to the legislation as such, but the reimbursed travel rates reduced from 398 cents kilometre to 382 cents a kilometre. Look, I think this decision was made when the oil price was lower, but since it was made, we've seen a massive upsurge. Yeah, I think this is a minus in terms of benefits to the taxpayer. So if your employer is going to reimburse you on a per kilometre base, it's always good to pay at the SARS rate so that you know that there's no other tax implications monthly or on assessment. This table is quite an important table that most people do not know about. This is your deemed travel expenditure table. This is the table that is in the SARS system for use when you doing your tax return and you want to determine your travel deduction. So depending on the cost of your car, if you look down the left column, you would be able to determine what the fixed cost in this calculation was, what the fuel cost per kilometre, and what the maintenance cost per kilometre was. What I use this for, mostly, I use this table to determine what is the most optimum travel allowance for employees. So if I can factor in what that optimum allowance is, I can be guaranteed that if the employees do the mileage they say they're going to do, that their deduction is going to be equal or greater than that, and that their travel allowance is going to be tax-free. Quite a simple calculation. So if you want to discuss that with me further, you're welcome to drop me an email. Subsistence allowances went up slightly, 139 Rand per day for incidental expenses and 452 Rand per day for meals and incidentals. I mentioned here as of March 2021, the incidental of 139 Rand applies to day trips, but we're going to discuss that a bit later. So just hang fire, please. No changes to the Medicare car fringe benefit legislation. No changes at all to severance benefits or retirement fund lump sum benefits. Here's the severance benefits table. It's unchanged, but just to give you a quick idea, this is the table that is applied if you are retrenched or you get a lump sum on retirement. As you can see, the first 500,000 is tax-free, but the rest of the table shows you what tax you would pay if the amount that you're receiving was more than 500,000. Pretty self-explanatory. This table is also unchanged. This table deals with the payments of lump sums prior to retirement. So if you were to immigrate, as an example, and you had wanted to pull your retirement funds, and we'll discuss this a little bit later. So let's just talk hypothetically here. You were in January this year, you were looking to immigrate and you wanted to pull your retirement funds. You would see that you only got an exemption of the first 25,000. The rest was taxed according to this table. So not pleasant reading. You would pay quite a lot of tax on your pension provident payout. For interest sake, I've just included some interest rates here. These are the current interest rates applicable to all of those facets. The corporate tax rate stays 28%, but as I said to you, that's going to reduce to 27% on or after 1 April 2022. So potentially two tax years' time for certain individuals. And then the rest of that information hasn't changed. The small business corporate tax tax table stays exactly the same. This micro business tax tables, that also stays the same. Actually do not know even how many entities in trading at the moment utilize this scheme. Not one of my clients use it, but Fiscus that deemed it to be important enough to retain. The new annualization of provident funds. Those of you who have attended seminars or followed this issue before will know that this issue has been dragging on for 3 or 4 years. Very briefly, the history. Government is looking to reduce the dependency of people on government, on retirement. So they were looking to make it attractive for people to contribute to a retirement fund, whether that be through their employer or privately. At the same time, they increased the tax deduction. So as I mentioned previously, you're entitled to 27.5% of your remuneration / taxable income as a tax deduction, and up to a maximum of 350,000 a year. But at the same time, government looks to plug a hole. What is that hole? That hole is the fact that people on provident funds could effectively take their money every time they changed employment, and considering the average employment period in South Africa was 3 to 5 years at any one place, contributing for 3 to 5 years, your average person said, there's not enough money in that fund for me to really reinvest it. I'm going to invest in a new car, or I'm going to fund my honeymoon, or I'm going to buy something with it. So money was coming out of the retirement net. So SARS looked to change the way provident funds were treated, and they said that as of a certain date, which is now 1 March 2021, any contribution to pension provident or RA fund would be treated the same. You'd be entitled to a 1/3 deduction in cash when you retired, and the other 2/3 would be treated as a monthly annuity. So effectively a pension for however long that money lasted. Any monies in this fund prior to 28 February 2021 would be ring-fenced, and that would be treated under the old regime. So you could effectively take that money, and also it was ring-fenced for, in terms of tax treatment, as and when you cash out of this fund. The same legislation regarding the minimum amounts as per the de minimis rule applied. If I remember correctly, it was 247,000 or 247,500. If you retired and your fund was less than that, it wasn't cost effective to keep you in the funds. You were allowed to take it under the old rules. Moving on. Some more legislative changes. ETR rollovers, employment tax incentive. Those people who work with payroll will know the trauma of dealing with ETR. Think back to the implementation of ETR, the uncertainty, the fact that ETR was dropped on taxpayers just before the election as a means of saying that government was trying to boost employment. We all know it was an absolute disaster. It was a failure. SARS got stuck into poor taxpayers for being non-compliant or applying the legislation incorrectly. I just think of ourselves, trying to assist clients, trying to interpret legislation. Normally what happens is when SARS, National Treasury, are looking to make such a change, they normally run this by the Payroll Audits Group, of which HR Talk is a member. And then what happens is discussions are held, tests are done to see whether this is workable. Unfortunately, when this came in, that wasn't done. So any panel beating of the legislation, any tests, any bugs came out in the next 2 years, probably even more. ETR was also sold to the public as being of limited duration. It's now been extended to 2029. So we're going to have ETR in our payrolls for a long time still. No sooner had we started to get our teeth into ETR and understand the rules, COVID came along. And Governments, in their wisdom, decided to change the ETR rules to make them more beneficial, which obviously we can't claim about. But the way that that happened, once again, was not done very well. And the majority of our clients were having to do ETR calculations out of payroll to try and determine what happened. In the defense of governments, obviously, the COVID thing happened quite quickly, and there wasn't a lot of time for discussion, but the process was very traumatic and challenging, particularly if you were working in the outsourced payroll environment. But we seem to have moved through that. The big challenge to employers now is audits. I think we're going to have lots of audits coming up, whether they be face-to-face audits or online audits. But I think ETR claims are going to be audited to check compliance with the law, and you're going to see a lot of reversals. Another challenge we had with ETR was the e-filing system saying that a company was compliant, yet when we utilized the concessions or ETR improvements or the other COVID concessions, they were declined and there was penalties and interest. So very traumatic period for people in the payroll environment, or anyone who runs the payroll. But we seem to have moved through that, and let's just hope the audits are kept to a minimum. As of the 31st of July 2020, the rollover rules for ETR have been amended to be the same for both compliant and non-compliant audits, compliant taxpayers. At the end of the reconciliation period, any amount still there is forfeited. Why that's been changed was there was a bug in the legislation that allowed non-compliant taxpayers to claim ETR rollovers when they became compliant, even if that meant that it rolled over beyond the end of the 6-month reconciliation period. Now, that would be very wrong to reward someone for being non-compliant for so long. So, just to conclude, there, at the end of the 6 months, any ETR that can be rolled over is forfeited. Bursaries, in 2006, any restrictions were lifted that allowed for, that previously disallowed salary sacrifices to fund bona fide bursaries. And since 2006, we've had companies mushrooming in this space, offering to help employers structure their remuneration structures of their employees to factor in a bursary, thereby saving employee tax, thereby potentially assisting the employer with BE scores, and obviously not causing suspicious of this. And I think that suspicion goes back to my SARS days, where this word salary sacrifice were no. Salary sacrifice always attracts attention. Obviously, because you're sacrificing taxable income. So, as of the current tax year, we're going to see some changes. It is proposed that the exemption will only apply to open. You can't, in your little company of say 20, 30 people, give bursaries only to employees. What will qualify as open, in my mind, that would mean you have to advertise it publicly for all people to be able to apply bursaries. The bursaries is going to be very difficult, okay, unless it's an open bursary. same bullet, there may not be any elements of it. So what we do is we say, okay, I now £20,000 a month, and me is I'm going to pay less tax, okay, and I'm going to have this bursary funded, as opposed to me using my after-tax money. So, good scheme. Unfortunately, with the legislation as of March, the legislation says that there cannot be any sacrifice of salary to fund such a scheme. What that means is you cannot take existing salary and forgo it in return for bursary. The employer deduction is only available if the bursary is not subject to any elements of sacrifice. So, obviously, you as an employer want to claim this cost in your income statement as a cost of doing business. If you require the employee to sacrifice any even future income, you cannot claim this as a deduction. So that becomes very unattractive. In future, bursary benefits must be disclosed on the UNIP 5. Many under salary sacrifice schemes were not. And why weren't they? Because employers didn't want SARS scraping around. Not making full disclosure of the bursary will be a criminal offense. I think what will happen, those companies are going to disappear because it's not going to be beneficial for employer intending for it to be a salary sacrifice. Reimbursing employees for business travel. Previously the legislation applied you could give an employee a subsistence, okay? There was no concession for day trips, okay? Now, for a day trip, the advances are not subject to tax. For the subsistence allowance. Now, that's right to travel. So, quite important to look at your employment contract. Those employees that are very, very specific allowance, or even if they are required to travel overnight, who pays what in terms of accommodation meals and what thresholds there are. Very important not to let an employee travel without that information, because if you don't, you're going to have some employees that see for platters every night, whereas a good policy would specify the maximum is 150 Rand or whatever. So I am doing a webinar next Wednesday at 9 o'clock on travel allowances, company costs and subsistence allowances. You're welcome to log in for that, and I will expand on this point. So just to summarize, the employer must have an official policy that allows the employee to go on a trip. Always good to specify what types of costs you expect the employee to incur. and important to note that they with the on a reimbursement basis. I know a lot of companies, the employee who's required to be out for the day would incur expenses as per policy, brings back slips, they're signed, authorized, and paid. There's nothing wrong with that. Quite a thorny issue, the withholding of retirement funds for 3 years when immigrating. This legislation has become very, very tricky. There's not a lot of knowledge on this topic in the market, and we get a lot of inquiries regarding immigration. A lot of inquiries from people who have left South Africa 10, 15, 20 years ago, who have got RAs in this country and want the money out. This is going to put cats amongst the pigeons. As of 1 March, taxpayers doing financial immigration will not be able to. Previously, taxpayers could access such funds after successful sure, and they've just received training on this. That training is as clear as mud. Why do I say that? SARS haven't given any guidelines as to the 3 tax returns where you state you're non-resident. Is it copies of passports? Is it copies of employment contracts overseas? Is it an affidavit from a councillor in the area where you live? Overseas? We don't know. So, yes, and in a lot of cases, those people require that money to settle overseas. Taxpayers who filed their applications prior to 28 February, and which is approved by SARS before February 28 February 2022, will fall under the old rules vote. Then also, obviously, due to COVID, had some travel concessions. If you are working under contracts of employment overseas and you are out of the country for 183 days in any 12-month period, and you met the 60 consecutive day requirements, you could your earnings would be tax-free to the value of hurry back to South Africa and join their families. So there was a concession to Treasury to reduce that to 60 days. All rules were lifted. People quickly had to go and spend 60 days out of the country. Very, very briefly, expats in South Africa, working in South Africa, are only taxable on their South African income. So maybe watch this space. There might be some concession, but as I said, at this point, there's none. SARS sharpening their teeth. We mentioned it a bit earlier. But probably the most controversial of all the issues was the change in legislation that was snuck through with the word willfully removed from legislation. Okay. Now, SARS have been pretty easy on taxpayers when it comes to non-compliance. And in my days at SARS, and even after, you know, it's very, very difficult to prove unless you can prove statements from third parties, or well, the word willfully has been removed, so that's going to make it very, very significantly easier for SARS to apply penalties now. They don't have to prove that he willfully did something. It would only be guilty of a criminal offence for non-compliance if they willfully fail in their tax obligations. This has been removed, and any areas of non-compliance can now subject you to huge fines or up to 2 years in prison. So I know this sounds quite scary, and I'm hoping that SARS would still apply their mind, but I think for your more technical cases where there's big numbers and it could pretend the willful issue could go either way, I think SARS are going to be throwing the book at those taxpayers. So realistically, SARS could prosecute taxpayers for failing to advise information. Think quickly in terms of your own tax return. That could be 2 years in prison. Failing to am I still on? Sorry about that, our internet just dropped quickly. What do I do now? What do I do? It's only at the bottom there. Hi folks, sorry, got a drop in the internet there, sorry about that. So to go backwards a few steps. Okay, so I was chatting about the need to build more jails because of huge amounts of non-compliance in this area. Other new SARS powers, the ability to withhold a refund if the taxpayer is under criminal investigation. I don't think that's a hugely problematic issue. Just, you know, obviously, as long as SARS are playing by the rules and not dragging their feet, that's fine. SARS can now issue an estimated assessment when the taxpayer fails to respond to a request for relevant material. The amendments also prohibit the taxpayer from lodging an objection against the estimated assessment until the taxpayer supplies the required information. Uif Compliance Certificates, huge change that we've had for some time. Those people who have applied for these will know that previously you had to send a certain documentation, including an application form, to compliance at the Uif department. This is now an online system, so you can register online for the company, and you can do this process online. It sends the return automatically to someone. The process is done automatically. In other words, you submit it, the computer system will tell you immediately whether you're compliant or not. Just had an unfortunate situation where a client was non-compliant. We paid the amount, and Labour takes 7 days to allocate the payments, only to be told that we now owe 40 cents. So that means the compliance certificate will now take another 7 working days to be issued. So, as I've said, the process is not straightforward. It's fraught with challenges. We've had rejections due to employee start dates and contributions not matching. Previously non-compliant employees are attached to current employers, causing a denial of the certificates. And then also huge challenges in not receiving input back from the Department of Labour how to fix issues. You know, dealing with the Department of Labour, it's just impossible because you can't talk to a warm body. So the system, I know, is under discussion with the Payroll Authors Group. We're looking at potentially limiting the check that the Department of Labour applied to a 4-year period. That will obviously eliminate all the challenges that we've had recently that go back to 2000. Workmen's compensation, there's been a change to the definition of employee to include domestics. This has been in the pipeline for some time. You'll know that domestics were previously excluded. That all changed on the 19th of November 2020. There's obviously a change to the definition of employer to include any employers that were previously excluded. And there's been a widening of the definition of remuneration to be more like the income tax definition. We've also seen change in benefits, the provision of rehab facilities to ensure effectively that your employee who's injured or sick on duty and then integrate that into the work environment. There's also been talk of more stringent initiatives to enable inspection, compliance, and enforcement. So they're talking about SARS type audits from the Department of Labour. That fills me with dread because the quality of labour inspectors that we've seen, there's a lot to be desired. So having workmen's comp inspectors out there would be quite scary. Brief basic conditions of employment change. The earnings threshold has gone from 205,433 to 211,596.30 cents as of 1 March. Now this BCA threshold is the threshold that applies at which an employee, for example, doesn't qualify for overtime or automatic protection in terms of those issues that are covered in the bullet points. So it is quite important. It's quite a big change, and it's a change that doesn't happen that often. But I think, you know, with inflation and the time value of money, it was important that they made this change. We are sending a newsletter out on Friday, and it includes more details on this threshold change. National minimum wage, that goes up, well, that changes every year. Government Gazette dated 8 February 2021 confirms the national minimum wage is 21.69 per hour. The national minimum wage for domestics, importantly, is 19.09 Rand, and public works employees is 11.93 Rand. Important point to note is that farm workers are for the first time in line with the national minimum wage, and Labour have said that they are doing the very best to ensure that domestics are in line with the national minimum wage by next year. The Basic Condition Employment Act defines an employee to exclude independent contractors. The national minimum wage, however, defines a worker in the same way, but does not exclude independent contractors. The effect is that independent contractors, in terms of the common law, must be paid at least the national minimum wage. This does not, however, apply to ETI and the UIF Acts. PAYE, that's another thing that we've covered in our seminars for the last 3 or 4 years. This came into operation on the 1st of July, but they talk about a grace period of 12 months. By 1 July 2021, all employers, any entities must have implemented policies and comply with all the requirements of the Act. There are still a few regulations to be finalised and a due date determined, but we will keep you up to date if you're on our newsletter reporter list. Employers need to apply themselves to the application of the PAYE in all aspects of the employment life cycle. And in the next slide, I've just shown you what that life cycle is. Engagement, onboarding, management, termination, separation. PAYE is something that must not be taken lightly. The penalties are huge. It's important for companies to implement a policy and live that policy. It must be a living document, and it must be taken seriously. Dealing with any third-party information it's vital that you have processes. That information gets out as a diet. Gifts, vouchers, and other benefits. Particularly over Christmas, we saw we actually saw quite a lot of entities looking to change the way they rewarded employees. Christmas functions were out and vouchers were in. Often employers would say, well, I'm going to give my employees meal vouchers. They can go enjoy some time with their family. Providing meals in the workplace is a tax-free fringe benefit, provided it is used during ordinary or extended work hours. A meal provided by the employer, there's nothing wrong with that. But when you start providing vouchers that a person can use anytime, that's usually problematic. And in our opinion, the provision of a voucher relates, a fringe benefit given to that employee. We did chat to the payroll authors group in this regard. They took it up with SARS. And SARS said that they were very happy with the existing legislation covering this sufficiently. So in other words, the provision of a voucher or any gifts by virtue of employment, and that's a very important words, by virtue of employment. If SARS can prove that there's an employer-employee relationship, you're giving a voucher, that would constitute a taxable fringe benefit. There's a grey area in terms of vouchers or gifts for birthdays, anniversaries, some sort of flowers on the death of a family member. Payroll authors group are convinced that there's no tax implication, but unfortunately I have seen SARS apply that differently. The presentation, we're about 10 minutes early, and unfortunately I've lost access to the questions. I'm just going to ask Priyanka to call up the questions quickly. Okay, No questions so far. We obviously had a bit of a problem with internet, so if anyone wants the slides, just please contact me at Dave, D-A-V-E, at HRTORQUE.co.za. I'll happily send you the slides. In terms of CPD points, I can give you confirmation in writing of the length of time that the presentation took, but please note that it will be unverifiable because there isn't a quiz, and also we are not registered to provide CPD authorization. And then just to thank you for attending, thank you for your contributions over the years to HR Talk in terms of those people who are clients. COVID has been tough, as I've said, and we don't often get to see our clients as much as possible anymore, but we haven't forgotten about you. We try desperately to put out as much information, so please keep an eye on our website, sign up for our weekly webinars, sign up for our reporter, go onto our website and see what's available. You know, we on YouTube. We've got all sorts of presentations on YouTube. So, you know, we're trying our hardest in difficult times to make sure that people stay abreast of legislation. And one parting shot. We also provide what we call a gap analysis to identify where you might be falling short in your payroll HR space. If you would like to explore that opportunity, please also drop me a line and I will communicate with you offline. Thank you once again, and look after yourself and stay safe.